Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
A last-minute deal to avert a U.S. shutdown is looking more unlikely. Kevin McCarthy lacks the leverage to clinch a deal. Meanwhile, Republican candidates attack Donald Trump for skipping the party's primary debate and hit President Biden for the country's economic woes. Oil pumps higher. WTI briefly kisses $95, the highest level in more than a year, pressuring global markets and central banks. Danny, a very good morning. It almost felt as if the barbarians were at the equity gate, and certainly the bond vigilantes are alive and well. Still pressure on equities as oil nips higher. You'll take us through the nuances there. Global equities at the bottom of your screen. You've got Micron at the bottom of your screen, down 4.9%, warning this next quarter is going to be tough for them in the fourth quarter. Oil pumps higher, and again, pressure on central banks will come to bear. Oil markets are the top story this morning. Global equities are down for the 10th straight session. What you have here is a line from Neil Kashkari, which is really quite stupendous by itself. If you're going to hang your hat on this, the government shutdown, the auto strike, could slow the economy and therefore temper what we need to do. Volatility is artificially repressed, according to Kalanovic over at JPM. Equities are down, SPUs, NASDAQ and European stocks. And there's a big concern out there. There's an options trader alive. JP Morgan has a massive fund, $16 billion JP Morgan hedged equity fund. They've got a monster position of put options that somebody has got to take a hold of on Friday. Danny, good morning.
Good morning, Manus. I'm impressed you got around having to say delta hedging. I think we can set aside the Greeks for this morning, so thank you for that. Look, elsewhere, the euro is trading at 105. Sure, it is strengthening today, but we are at the level that a lot of forecasters have for their year-end targets. Are we going to have to do a rethink of just how weak the euro might be getting? We did have some regional German CPI data come in. We'll get the whole country at about 1 p.m. UK time. We had Spain data come in, too. All of that did come in less than expected. So it's impressive the euro is rallying this morning, but maybe that's just a bounce back from what we've seen from one of the longest losing streaks for the euro since the 90s. If inflation is starting to come down in the euro area, surely it's more bad news for the euro and an ECB that might be faced with weaker growth and the inability to continue to hike. 10-year yields, Manus, you had mentioned this. We're looking at a high of October 2007. We are now above 4.6%. A move higher of 3 basis points this morning. The turnaround was remarkable, despite Neil Kashkari warning that they might have to stop should there be a government shutdown. As you said, Manus, 15 basis point move from the low to the high yesterday, the most in about a month. A big turnaround showing that the bearish momentum is here. And Manus, this is part of what's causing that bearish momentum. It is Brent crude up 0.1%. It's at $97 a barrel. We had a major U.S. stockpile come in much lower. Manus, it does start to feel like the tightness of this market, that $100 a barrel feels like maybe an inevitability at this point.
And that's exactly what ING are saying. This is going to be perhaps a short-lived pressure. I thought we'd go for the squeeze. This is the spread. This is the front spread. In other words, the price of oil today relative to a little bit later in the year. And as you can see, it is squeezing aggressively higher. That gives the Saudis the ability to raise their prices to their Asian customers. Amrita Sen said to us she thinks that this is to do with the destocking, but this pressure point at the front end of the curve is driving the market higher. We'll discuss this and more with Bob McNally from Rapidan a little bit later on. But let's take this squeeze in oil. It's caused angst in equities. It's a vexation for central banks. To Wei Li, Global Chief Investment Strategist at BlackRock. Wei Li, good to see you this morning on your European tour. How close are we and how real is $100 oil? And what are the implications in the medium term of, let's say, a range of 95 to 105, as people are saying to me? Good morning.
Good morning, Manus. I'm your Berlin correspondent for the day. Yes, indeed, oil price pushing higher in response to production cut news and supply constraint has been sending markets and pushing up market volatility. And that's actually the broader kind of backdrop of a world shaped by supply that we believe in. because we're in this new regime right now. So you talked about how some of the inflation across Europe and more recently also in the US coming down and alleviating some of the concern. But I think oil price spiking higher is just is the evidence that we're actually in an inflation roller coaster rather than getting out of the woods with inflation fighting. And it's not just the oil price, it's also thinking about what's driving inflation. The pandemic shock unwinding has brought inflation down, but labor constraint is going to push inflation higher.
To that point, just in terms of the higher inflationary regime, that's obviously had an impact on Treasury yields. We're headed for a historic 3 consecutive years of losses. We're in uncharted territory when it comes to that. What will be the impact of this rethink on the bond market?
Well, also in a different regime with regards to bond market investing. So the ballast of bonds in portfolios has been more challenged, as we have seen last year, as we have seen this year. But income is finally back in bonds. So far this year, the temptation is to look at what's happening in markets through our equity lens. But equities have been very, very concentrated if you look at the US equity market. So really, we believe we should be looking at market dynamics through a rate repricing lens. And so far this year, 10s has moved up by 75 basis points. A large part of that was started early on in the year through cash path repricing. So markets kind of waking up to central banks are going to have to stay higher for longer in this world shaped by supply. But more recently, we also had term premia coming back. Term premia has been deeply negative for a very long time. But in the context of higher bond volatility, in the context of QE giving way to QT, in the context of fiscal imbalance and greater issuance, term premia has more to go, and which is why we have been underweight US long duration for a while, and we continue to be underweight. Now, some opportunities are emerging
Wei Li, just hold your thoughts on those bigger
repricing.
Opportunities, and we're going to reset to those.
Yes.
I like the fact that you put the context around it. We're on this roller coaster, and we're not out of the woods in terms of inflation. Hold that thought on the roller coaster. We've got 3 other major stories that we are tracking today on Bloomberg Brief. We got a late deal to avert a US government shutdown is beginning this weekend. Isn't likely. That's the thinking at the moment. The House Speaker, Kevin McCarthy, making big demands and bringing very little leverage, Danny, to the table at the moment.
Yeah, it's certainly worrying with just, a couple of days to go until that shutdown. The other big story we're tracking, Manus, is Evergrande and its units suspended trading in Hong Kong. That's a day after people familiar with the matter said that the property giant's founder had been taken away by police, Manus.
Well, of course, then we just had this inflation data from Spain accelerating for a second month, demonstrating the persistence of inflation, the pressure for the ECB to live in this higher for longer regime in their interest rate outlook. Seeking to stamp it out is the challenge. Spain's figures kick off a spate of inflation data across Europe, with the early regional data from Germany pointing to a steep national slowdown. Wei Li is with us. You've already made it very, very clear that we are on this roller coaster for inflation. So set the table for us in Europe. I know that you've got a preference for being longer of UK and longer of European bonds relative to the US at this moment in time. But how much of that is predicated on rates remaining at this 4% level in Europe? Wei Li.
We do have the view that rates will remain higher for longer across developed market central banks, and this is really the result of us being in this new regime where central banks are likely going to have a tightening bias as opposed to easing bias during the great moderation in response to supply constraint coming from labor market, in response to supply constraint coming from geopolitical fragmentation, as well as the net zero transition. So we do think that term premium has more to to come back in the case of the U.S. Government bond market. But the picture is slightly different in Europe, where actually after recent market repricing, there are income opportunities emerging and also kind of mispricing versus our expectation for where the cash path would be for the ECB as well as the BOE. In that, if you look at market pricing, we're just looking at 4 cuts in total, in perpetuity by the ECB, which we think is a bit conservative, is a bit extreme. So even though we have the assessment of rates higher for longer, central banks holding tight, our investment view is predicated on what's in the price, and we're starting to see opportunities emerging in international developed market duration, which is Europe and the UK, but not quite in the US yet, because we think that there is greater room for term premium to come back in that is starting now.
Well, you're talking about some of the mispricing in assets, and we talk about this very frequently. I want to turn this on its head. What do you think makes sense in this market right now? We talk about bubbles in tech, bonds not pricing on the right thing. What do you think is fairly priced in this market right now? What asset is logical to you?
Well, I talked about fixed income investing being in this new regime where finally income is back. You're talking about 5.2% sitting on the front end of the U.S. Treasury market without taking duration risk, without taking credit risk. That's very, very attractive, especially at this juncture, given nervousness in markets. So we continue to favor the front end of the U.S. Treasury market. One thing I would say, though, is in light of recent, actually, also equity market nervousness in response to rates pushing higher. We have been less positive on equities, but with adjustments coming through, I think opportunities we're getting closer to opportunities down the line. And then Japanese equities has been a bright spot in the context of still very easy monetary policy environment and very shareholder-friendly policies, and also some of the incentives being put in place for domestic investors to get into the equity market, and all of that are teeing up for Japanese equities to be the bright spot at this current juncture, even though the broader sentiment is really feeling the weight of rate repricing, which is just starting.
Okay, well, there's pressure in that Japanese government bond market this morning, so we'll return to that in just a moment. And you whetted our appetite on a little bit more term premium. Wei Li, we'll see where the value lies from BlackRock Investment Institute. Our guest this morning, our Berlin reporter personified. Oliver Crook will have a job of competition. Now, the Republican candidates assailed President Biden's handling of the UAW strike. Auto workers, they're threatening to expand their strike on Friday. We'll have more on that. And last night's frisky debate. Oil marches higher, closer to $100 a barrel. We discuss that with Bob McNally, president of Rapidan Energy Group, a little bit later this hour, right here on Bloomberg.
I side with the auto workers of America and with those who want to make America great again, and I always will.
That was the former U.S. President Donald Trump speaking in Michigan yesterday. He skipped last night's Republican debate to woo the blue-collar voters in that battleground state. Bloomberg's Oliver Crook is tracking the trails this morning. What was the top line of Trump's message? Good morning to the auto workers.
That's right, Manus. He was speaking at Drake Enterprises, actually a non-union parts shop over in Michigan. Really, his message was about economic nationalism, favoring American labor over foreign labor, and really taking a very negative approach and vision of China, and also a negative approach of Biden and EV mandates that he calls are selling out to environmental extremists. This has obviously not been very convincing to union leadership, a fact that Trump is very aware of. In the speech, he said, "Get your union leaders to endorse me, and I'll take care of the rest." And there's an irony here. He spoke in Clinton, Michigan, a state that obviously Hillary Clinton lost and was accused of neglecting during the election. Biden won it, but only by about 150,000 votes, and that was in part because he got 62% of union households.
Yeah, such a crucial measure for the Rust Belt. Oliver, what is the latest on negotiations?
Well, we have another countdown clock, Danny, so set your watch or whatever you use. 10 a.m. Eastern Time. Sean Fain will go back to the airwaves, Facebook Live, to give another ultimatum for the big three. If there is no progress made, he will expand the strike even further. And where are we on the actual negotiations? 20% is what's been offered, 40% is what's been asked for. What has changed since last week? Well, for one thing, Biden went out and sort of tacitly backed that the workers should negotiate 40%. Now we understand that the negotiations are around pensions, bringing those back, which were scrapped in 2008 after the restructure. And also now, Ford saying that they're going to scrap their battery plant for the time being. That is going on hold. The union is seeing that as a bargaining tool. Will that mean that Ford is not spared?
Well, you're certainly not spared. I just want to get a sense, Oliver. This is the first time, Wei Li, great to see you in Berlin, but this is the first time Oliver's actually got to share space with anybody. So, do you feel the heat, Ollie? You got a bit of competition?
Well, I mean, it sounds like there's a job opening over at BlackRock, so maybe that's where I should send my CV.
Oh, you could just see him walking up to the front of the podium tomorrow to Larry Fink with Danny going, excuse me, Danny. Larry,
with our
how
new
are you?
correspondent.
I'm Ollie.
I'm sure he'll take to that well. I'm sure he will.
Oliver, we'll see you a little bit later on. Wei Li stays with Danny and I to discuss the government shutdown on a slightly more sobering note. You talk about mega trends and mega threats. Here we are. We're in the midst of a workers' strike in the United States of America, a shutdown that could affect 22 million people in the United States at nearly $2 billion a day. My question to you is this. You talk about mega trends and shifts, regime shifts. Are we entering a regime shift in remuneration globally? Are these idiosyncratic US and European moments?
Well, I was in Vienna yesterday where there is wage negotiation ongoing as well. So this is definitely not just a idiosyncratic, isolated kind of event in Europe, in the US and parts of Europe. It feels like as we think about kind of the broader constraint of labor shortage, the power is incrementally shifting towards the labor, towards the consumers, which are getting a bigger share of a shrinking pie, right? So these are the structural regime change that we are talking about. And as we think about the implication on inflation, it could push inflation higher, which is that roller coaster framing that we talked about.
Well, wait, to marry together two megatrends, not just that one, but the fragmentation, the geopolitical fragmentation also means we're doing this project of friendshoring, onshoring, that sort of thing. Will the project of onshoring work? And if it does, how costly will it be if all of a sudden labor in a lot of the Western domestic markets are much more expensive?
Yeah, friendshoring, reshoring are happening. They are happening slowly but surely in response to geopolitical fragmentation and likely representing a drag on growth and, again, gently pushing inflation higher. Would it work? I think in the context of labor shortage, we have to kind of really think about resourcing allocation. And this is where some of the technological innovation advancement can potentially come to the rescue, which is another mega force that we talked about. But just taking a step back, we're really at this moment where cyclical forces are playing out, but really interacting in an incredible way with the mega forces, which is why we really need to consider them in conjunction with each other as we think about even tactical asset allocation, not to mention strategic asset allocation.
You hinted earlier Japan as being one of the sort of more favorable areas. I look at the Japanese government bond market this morning. You're looking at yields at the highest since 2014. I mean, there's pressure in the bond market. The finance minister is talking about intervention. There's the JGBs this morning, but you're looking at some pretty punchy moves in this bond market. What is the biggest tail risk in Japan for us?
Well, I think global markets, global bond markets are very, very correlated. Something happens in the US, it gets fed through overnight to APEC, if it gets fed through then overnight to Europe. And I think what we're seeing in Japan is also some of that global correlation playing out. The biggest risk is if YCC exit is faster, more sudden than expected. You know, it is a matter of time, not if, but a gradual exit exit from yield curve control, together with the still very, very shareholder-friendly policy, are likely going to still position Japanese in a better light relatively versus the other parts of the market. But just tie back to mega forces again. We're talking about, not super rosy macro backdrop, stagnating macro backdrop. So really focusing on mega trends, mega forces as we think about what could potentially bring that additional return to your portfolio is key, which is what we're focusing on right now.
Okay, Wei Li, thank you so much. And you're welcome in the Berlin studio any day of the week with Oliver, Danny, and myself. Wei Li from BlackRock there. Quick snapshot of what's going on with currencies. The dollar breaks trend with 6 sessions in a row of gains. We've just rolled over this morning. SocGen says a prolonged U.S. shutdown would bring peak dollar closer. Yen strengthens ever so slightly as the finance minister steps out and says they're ready to take appropriate action. A small bid to yen. Good morning from New York. Welcome back to Bloomberg Brief. I'm McNally in New York.
And I'm Danny Berger in London. Here's what you need to know. A last-minute deal to avert a U.S. shutdown is looking more unlikely as Kevin McCarthy lacks the leverage to clinch a deal. Meanwhile, Republican candidates attacked Donald Trump for skipping the party's primary debate and hit President Biden for the country's economic woes. And oil pumps higher. WTI briefly hits $95 a barrel, the highest level in more than a year, pressuring global markets and central banks. Let me show you those global markets. The euro with remarkable strength this morning, given that we've seen CPI figures for regional Germany and for Spain come in weaker than expected. We're up about 0.2%. We're still at 105.27 on the euro versus the dollar. This is a level that many folks had for their year-end forecast. Are we about to see en masse revisioning? U.S. 10-year yield, that continues to march higher. We're up by 3 basis points. 4.6% is where we're at, the highest since 2007. We're on track for a historic 3 consecutive years of losses in this bond market. And finally, Brent crude finally seeing just a touch of relief. I mean, barely, though. Brent crude, $96 a barrel, weaker by 0.2%. And Manus, we were just talking to BlackRock's Wei Li about this, hearing something that we often hear, that this will keep the higher for longer narrative on track, with Brent crude marching its way to $100 a barrel.
Yeah, she said very clearly we are on a roller coaster in regards to the inflation narrative. I said to you 30 minutes ago, it felt like the barbarians were at the gates of the equity market, more pressure to come, and that is becoming ever more present through the morning. You are just seeing that spike in yields. I mean, it was pretty vicious yesterday. And again, the equity market is struggling here. Global equities are down for the 10th straight session. Bottom of your screen, down 0.2%. Again, that eruption in yields yesterday really unseated the overall nerves of the market. And oil is the very it's almost like the pumping muscle of angst in terms of what happens to gas prices here in the States. Stocks are lower this morning by 1/8%. Micron at the bottom of your screen warned it's going to be tougher going into this final quarter of the year. And for them, they look as if they're trading lower this morning. Decisive actions will be taken on cost. Micron at the moment is down. Let's have a quick look at the price of that at the bottom of your screen. NASDAQ, again, struggling with this higher for longer narrative. Actually, Micron comes back up by 0.4%. Kalanovic over at JP Morgan says this low volatility regime that you've enjoyed will not last. And of course, we also have a monster position in options by one of the big JP Morgan funds out there, the JP Morgan Hedged Equity Fund. It's a $16 billion fund. They've got a monster position in puts, which of course they bought, somebody or a number of people wrote, and they potentially have to take delivery of stock and go, no, we're not having this. So at the moment, Danny, those are the pressures.
Yeah, they are the pressures. I'm also just looking at this Marko Kalanovic note that you mentioned, Manus, of JP Morgan, also saying that markets today rhyme with the 2008 crisis. Now, he's been bearish on this market for some time, but certainly not comforting, saying the core risk for markets and the economy is tied to the interest rate shock of the past 18 months.
Yeah, and here we are. We're beginning to understand about new regimes. BlackRock have just talked about a new regime. We've had various guests this week talk about the regime change that we're going to. Jamie Dimon, not just flying kites, but saying the market is not ready and has not countenanced the possibility of 6 and 7%. But let's circle back to the oil story, Danny, because it did kiss that $95 a barrel yesterday. We've got dwindling stockpiles at a key storage hub, fanning the fears that falling crude supplies globally is going to put more pressure on this market. Bob McNally is president of Rapidan Energy Group. It's his first outing on Bloomberg Brief. Normally he's in the overnights with me in the Middle East. Bob, here we are. We've got a very, very damned tight market. The spreads are exploding. The front spreads are exploding higher. First of all, define how tight the market is right now.
Good morning, Manus. So the oil market is getting squeezed and getting squeezed hard. But there's more tightness to come. You know, we're all watching the Cushing inventory depot, right, where WTI is priced. That is heading towards, you know, record low levels, minimum operating levels, really. Now, that'll ease up a little bit, Manus. The refiners are going to turnarounds, et cetera. So maybe we stop nosediving in Cushing. Elsewhere, oil on the water, other places for crude, you know, it's been falling. Stocks have been falling sharply worldwide, but they're not yet at critical levels. Where the real problem is, Manus, going into winter when we burn heating oil, diesel, middle distillate, their stocks are quite low. Europe, Asia, the East Coast. So if I'm an economic planner or a politician, as the winter starts to fall here, I'm worried about those diesel stockpiles and diesel demand especially. But the market is clearly tightening, and traders needed to see it to believe it. And they're seeing it and they're pricing it, but we're not done with this tightening move.
Can you put the numbers to the winter, Bob? Exactly how expensive, what exactly will that result in to see that demand for energy come this winter?
Well, so everything depends really on what Saudi Arabia does. Crude oil is the main driver here. At Rapidan, we've been expecting $95, $96 fourth quarter average Brent prices, meaning, to use Manus's word, daily prices kiss 100 or blow through 100. That's going to put, you know, distillate cracks, the difference between distillate fuel oil and crude oil has been about $50 a barrel. So, you know, we're not going to go back to last year's levels. But here's the deal, as you were talking about, the economy is so fragile. This isn't 2013 or 2012 when the world's growing at 6%. Doesn't really matter. We could go to $120, $130 oil. It doesn't matter. This is a much more fragile, hoped for soft landing kind of economy. So even if we punch up to the high $100 level, $200 level for distillate now per barrel, not crude oil, you know, $100, $105 a barrel, that's the last thing the Federal Reserve and the central banks needed as they were trying to bring the global economy in for a soft landing. But I think we could see easily in the United States $4 gasoline, and distillate, of course, is quite higher.
So I want to take you back to your time when you were with President George W. Bush. We draw on this from time to time. If oil doesn't just kiss, but has a full-on affair and goes over $100, what does that do at the White House? What does that do for Amish Hochstein? What does that do for Biden? Do they have to step in and use the SPR again, which is already, I would say to you, at a dangerous level? Or you can qualify that for me. First of all, SPR draw. Is that what happens when we go over $104 at the pump?
I think that's the first resort, probably, but not a big release like 180 million barrels last year. No, they'll probably repeat November of 2021, where they put 30 million barrels or something like that on the table, and then call around to friends and family and the Chinese and see if we can get some contributions there. I don't think they are worried about that 40-year low in SPR. I don't think they'll do another 180 million, but that's it. You know, after that, badgering OPEC and Saudi Arabia in public doesn't work. They're not going to do that. Plus, there's this big diplomatic deal. Here's the real risk, Manus. As we're seeing in Russia this week, critically, there will be pressure to consider limiting the export of refined product and crude. If oil prices melt up, keep on melting up, they know it's a dumb idea, but the political folks may say you got to reach for whatever tool you have. And going and saying, you know what, the United States has got to keep more distillate and gasoline here. It would be a disaster, be counterproductive. But that was on the table last year and will come on the table again if we roof above $100.
Bob, what you talked about a soft landing and the impact that would have on oil. What type of landing, what type of recession would actually be able to bring oil prices back down?
You know, I think we would, on the recession side, we'd need a pretty big one, right? The most important factor for bringing oil prices down is going to be whether Saudi Arabia decides to ease up on the unilateral cut. You know, you don't want to do it with a recession. I think you'd really have to take 1 million, 1.5 million barrels a day out of global demand, you know, right now to kind of ease up. But I think then the risk is that the OPEC Plus just cuts even more under that. The real sensible way to bring prices to a sort of heel here is for Saudi Arabia and then OPEC Plus to say, okay, we've made our point. We've scared away the speculative shorts. We've proven that we're not going to let things get out of hand to the downside. We have a bottom in. We can start to feed back oil into the market. So I think that's the sensible way to do it. You don't want to do it with a recession because, again, with these interest rate hikes, things would get out of hand to the downside. It's a very delicate balancing act.
So tell me this, Bob. I mean, you've been in Vienna, you've been in the presence of His Royal Highness, etc. He took the heat out of this backwater by going for extension of the unilateral cut of 1 million barrels a day. What is the real risk that they will step back from that? Because essentially that's their way of creating the floor in this market. What is it that could force them to do that? In Calgary last week, he said, we're not going back to the 1980s. Do you think that they are sufficiently, as he likes to see himself, the central banker of oil for the world, are they politically enough aware to know how injurious 105, 110 would be?
Yeah, I think, Manus, the odds are higher than the market is currently discounting that the Saudis will take their foot off the brake sooner, right? They do not want to deliberately over-tighten the market because if you get a spike, then you get the demand collapse and you get a bust. They don't want that. So I think as we look at October, in a few weeks, they'll make a decision. In November, they'll decide about liftings. And they slipped some hints in there. In the announcement on the extension, the Saudis said, look, we're going to still review things every month. And they said we could increase production, whereas in the past they had only said we will cut or extend these cuts. So I think that he's dropping lines in the water. He's dropping signals that we're maybe getting close to the point where his point has been made, risks have been mitigated to the downside, and he can start to play that central banker role and ease up. We're not there yet, but we're getting closer.
Yeah, enough the speculators chased out, maybe. Bob, really great to get your thoughts this morning. We appreciate your time. Bob McNally of Rapidan Energy Group. Now, coming up, we're just 3 days away from a U.S. government shutdown, and a deal to avert it seems less and less likely. We're going to have more on that for you next on Bloomberg.
Donald Trump hides behind the walls of his golf clubs and won't show up here to answer questions like all the rest of us are up here to answer. He put $7 trillion on the debt. He should be in this room to answer those questions for the people you talk about who are suffering.
Bidenomics has failed. Wages are not keeping up with inflation. Auto workers and all American workers are feeling it, and families are struggling in this economy. And Joe Biden's Green New Deal agenda is good for Beijing and bad for Detroit.
Chris Christie and Mike Pence there among Republican contenders debating yesterday. 7 of the Republican contenders for the presidential nomination spent 2 hours hammering each other, President Joe Biden and the absent frontrunner, in a debate last night, who later, former President Trump, that is, just said, quote, they are all job candidates. Let's get now to Kate Ackley of Bloomberg Government. Kate, can I just start here on Trump's comment? They're all job candidates. Does anyone see a VP in the group? I don't know. They don't have a crowd like we have. Does it seem like they're just applying for the VP job, looking at this debate, or something else going on?
Well, I think it shows how dismissive Trump is. And, if you look at his lead in the polls, it does make some sense. He's the clear front runner. All of them combined, I think, don't have the same level of support among Republican primary voters as the former president does. So he wasn't on the debate stage yet again. but he also, again, got, big headlines. I mean, there are stories this morning about his rally in Michigan where he put the focus on the striking auto workers and, again, was very dismissive of his fellow rivals, sort of. He's almost taken a general election approach where they, in the debate, those 7 candidates, some of them got into really divisive issues that were focused on Republican primary voters that would then be harder to run in the general election. Yeah. Whereas you see Trump, he's attacking Biden, and he's kind of running a general election campaign already.
It's interesting, in one of the stories that we wrote overnight, Frank Luntz, a longtime Republican pollster, said the winner tonight was Donald Trump by not participating, and he described it as chaos on the stage. But part of the discussion on that stage was around the UAW strike, where Trump was present and talking to that agenda item, which is so hot button. It's on every news belt every day. How did the hopefuls or the pretenders, as it were, because they certainly don't have the percentage of the faithful behind them, how did they talk about the strike? What did they say they would do?
Well, I think for Republicans, the way that they have been talking about the strike is very interesting because, if you look back decades ago, the Republican Party was very much pro-corporations, anti-unions, but we're seeing different messaging this time around, and it speaks to maybe the changes in the demographics of the Republican Party. So we saw, Senator Tim Scott of South Carolina, he's been critical of these striking union workers. But even he was, working to try to say, well, the problem here is the Biden administration's agenda and, trying to move prematurely to electric vehicles, which will disrupt the U.S. auto industry. So trying to put the blame there. And we saw others on the debate stage as well you saw just in the clip that you showed, former Vice President Mike Pence saying, this is about inflation and blaming Biden and Democrats for inflation, blaming Biden and Democrats for this shift to EVs. So trying to, sort of fracture the labor movement, right, certainly the auto workers, so that they would support a Republican presidential candidate.
Well, Kate, the other big headline grabber in D.C. is this 3 days away from a government shutdown. Just focusing on the Republicans for a moment. For those who have many federal workers in their districts, how are they handling or not handling this?
Yeah, we took a look this week. We used U.S. Census data. Our team at Bloomberg Government looked at which lawmakers have the most federal workers in their districts. And no surprise, most have, are Democrats who represent districts in Virginia and Maryland, really close to Washington, D.C. But then there are some other people that you would not expect. Among Republicans, Florida Republican Matt Gaetz, who represents the 1st District down in Florida, which has a lot of military installations. He's up there, so I have to, check my notes, but something like 7-8% of the civilian workers in his district get their paychecks from the federal government. So, there's a dynamic there. If a government shutdown does occur, which looks increasingly likely, these members of Congress are going to be hearing from their constituents who aren't getting a paycheck. And so we are going to be watching that dynamic. It's one thing to talk about cutting government spending and fighting over funding for Ukraine and things like that. But it's another thing when you have a critical mass of constituents in your own congressional district who are not getting their paychecks for some period of time.
Kate, we're going to have to end it there. Thank you so much for waking up early for us. We appreciate it. Kate Ackley of Bloomberg Government. Coming up, Nike reports earnings after the bell. More on that next on Bloomberg. This This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. Let's get you set up for your trading day and a look at what's ahead. We're going to have German CPI coming in at 8 a.m. Eastern. We're also going to get U.S. data, GDP, core PCE, and jobless claims. All of those hit at 8:30. But will that influence what's coming up down the pipe from a host of Fed speak? We have Chair Powell, Governor Cook, Presidents Goolsbee, and Barkin all on deck. Again, do they need to recalibrate their message from last week? And Nike earnings, that will happen after the U.S. market close. Manus.
Well, let's see what we expect from Nike. The results are due a little bit later today. We're reunited. Simone Foxman, back together. Good to see you.
Good to see you, Manus.
Are you long Nike? Are you a Nike girl, a Lululemon girl? Can you show your bias on this show? But you can tell me about the numbers of Nike.
Well, I personally don't have the bias, but I will say analysts are pretty split here around Nike. I mean, they love the shoes generally, but it's a little unclear where the company is going at this point. There are a handful of different factors at play. I think three really top of mind. Slowing of the American consumer. Are they actually slowing down? That's the same question we've had for a long time. China, how is demand holding up there? China is a decently large part of their market, 14% as of last year. And then also, they're still managing some overruns in terms of inventory. They've had some success at bringing that down. Can they continue to show that success?
Simone, also, as of next week, we're going to have U.S. borrowers having to make student loan repayments for the first time in 3 years. We talk a lot on the show about the potential cracks in the U.S. consumer. Are retailers like Nike talking about this and the potential impact for them?
Yeah, Danny, absolutely they are. I was actually looking through some of the recent earnings calls. We've seen the likes of Kroger's, Academy Sports, Signet Jewelers, Best Buy, Gap, Ulta Beauty. They've all mentioned some concern about the impact of student debt repayments starting to play into their sales. Now, some are a little bit more concerned than others, but essentially the message is no one really knows how this is going to shape up for them. You know, you look at someone like Nike who's selling $100 plus pairs of shoes. Can they avoid this because their consumer is a little bit better off, has an overall higher income? You know, we've seen some retailers really be able to succeed in the past couple of months, don't seem to feel that impact. And then you hear, you know, Kroger or Costco worrying about how student loan debt repayments are going to impact them. So I think the answer is no one really knows yet. I think we'll certainly be listening for commentary on the call later today, though.
Very briefly, just to wrap up, how important is the dollar on this call and in the numbers, the strength of the dollar?
I mean, the North American business, 40% of their business, right? So that's ultimately the key fundamental bit there. But I think it is important. We're seeing companies start to adjust to these broader foreign currency exchanges. And certainly because the North American bit, the same store sales are actually supposed to decline a little bit on a year-on-year basis. You know, it could offset some of the strength we're seeing elsewhere.
Let's see how the numbers turn out a little bit later on today. Simone Foxman tracking the retail beat for us here. We're also going to keep an eye on Peloton after a deal with Lululemon. So, I got to say, Lululemon's kit, I have it from years ago here in the US. It lasts, it endures. You're a Peloton kind of girl, aren't you?
Yeah, but I'm going to be honest, Manus. I'm agnostic. I'll buy whatever's on sale. That's all I care about.
Listen, we're going to finish off with bonds. I said it to you at the start. The vigilantes are alive. The barbarians are at the bond gate. The question is, how much more will they shake down the yields? Danny?
Yeah, we are on track for a historic 3 years of losses for this bond market.